Hi everyone, you live in the UAE and set up your overseas company, maybe in the UK, BVI, in India or wherever. You have done all the documentations in a proper manner and made the incorporation legally. But the question is, where are the decisions being made? Because as per the UAE tax law, if the decisions are made by you living in the UAE or by a Dubai office, then this will be considered as a UAE tax resident company, which means this overseas company will have to register for corporate tax in the UAE and pay taxes on its overall global income. Today I'm going to be talking about how this works, what the FTA looks at, and what you need to be thinking about when you are running an overseas company from the UAE. Before we dive in, a quick disclaimer. This video is for educational purposes only. Do not treat this as professional or legal advice. If you find value in content like this, please subscribe to get regular insights on information tailored to business owners, CEOs, CFOs, and aspiring leaders. Now let's get back to the video. Let's first understand the law. A juridical person or company will be treated as a tax resident of UAE if any of the following are true. The first one's simple. If you have a company that's registered in the UAE, which means it could be the mainland, free zone, or even an offshore jurisdiction within the UAE, it will be considered as a UAE tax resident and will have to pay its taxes in the UAE. The second one, which is a little bit more complicated, is understanding where the effective management of the company lies. So even if the company is registered in a foreign jurisdiction, if the effective management is in the UAE, then this company will be considered as a UAE tax resident. In the tax world, we call this POE, place of effective management. If the company or a juridical person is considered as a tax resident in the UAE, it has to pay its taxes on its global or worldwide income, which means it's within the UAE and outside the UAE. Surely, there are elections in place to reduce or avoid taxes that were due in other jurisdictions. So if you have a BVI company which is effectively managed in the UAE and it has income, let's say, from contracts in Europe, dividends from India, interest earnings from the banks, all of this will be considered as taxable in the UAE. So how does the FTA assess if a company's place of effective management is within the UAE? This has been clearly explained in the tax procedures guide released by the tax authority. They've clearly defined it in two steps. Firstly, identifying who takes the decisions. Secondly, understanding where these decisions are being made. So let's get into step one. In general, there are three tests put in place. Test one, the board of directors test. The FTA looks at whether the board is genuinely making decisions or whether it's simply rubber stamping what someone else has already decided. A board that meets on paper, approves everything without question and has no real experience in the business, that's not going to satisfy the FTA. Test 2, the delegation of authority test. Even if the board exists, the FTA looks at what authority has been delegated downward. If the CEO is in Dubai and is the one developing the strategy, making calls, running the business, and the board receives a quarterly report, then effectively control may sit in Dubai, not where the board is formally located. And finally, we have test 3, the shareholders activity test. If the shareholder is doing more than providing guidance, if they are restricting the board's authority, making operational decisions themselves, or demonstrating what the board can and cannot do, then control effectively sits with the shareholders. And if the shareholders are in the UAE, then that's what matters. Once you've understood who are making the decisions, then we need to understand where the decisions are being made, which is step 2. Now, in this case, we will have to look at where the board of directors are located during these meetings. If it's a virtual meeting, we look at where they are located at that time. In such cases, board resolutions, emails, minutes of the meetings are all evidences to prove where they are. And what does not count as evidence? This is where most people get it wrong. If the company is simply registered in a foreign country like the BVI and the accounts are maintained in the UK, that doesn't make it as an evidence to prove that it is not tax resident in the UAE. Another nuance to consider is that if there's a one-off decision made in the UAE, that does not trigger POEM. What the FTA is looking for is regular decisions and permanent basis in the UAE. Let's try to better understand this with two separate scenarios, both which involve a UAE-based entrepreneur who owns a BVI holding company. In scenario A, we have an entrepreneur that chairs a monthly board meeting from the Dubai office by video call. The other two directors that are based in BVI but have really no involvement there. They approve whatever he proposes every time. He directs the strategy, he makes the calls. In scenario B, we have an entrepreneur that has delegated the strategy to a London-based CEO who runs the business autonomously. The board meetings are held physically in London. All the directors attend in person. The UAE shareholder reviews the quarterly reports but does not decide strategy. Here you can see it's the same company structure, same UAE owner, but completely different outcomes. Because the question is not where the company is incorporated, it is where the decisions are genuinely being made and by whom. Now, there's one more layer to this. If the company is considered as a tax resident in the UAE because of POEM, but also considered a tax residency in the foreign country in which it's incorporated, it could be considered as a tax resident in two different countries. This is a dual tax residency problem. In such cases, we would need to defer to the DTA agreements between the two countries. The UAE has signed DTAs or double tax agreements with multiple countries. Most DTAs contain what's called tiebreaker rules, which determine which country gets to tax the entity as a resident. Often, the tiebreaker rule refers to the place of effective management, which in this scenario would confirm UAE residency. One thing to be clear on is branches, permanent establishments cannot claim DTA residency. Only juridical persons. Companies with their own legal personality can go through this process. And if the UAE is confirmed as resident jurisdiction, that company must register for UAE corporate tax in its own name, not through a related party, not through its UAE parent. The entity itself registers and files. So what do you need to take away from this video? If you are a business owner in the UAE with overseas company, you need to consider POEM, place of effective management. Where in reality is all the decisions being taken? I hope this video gave you a better understanding of the place of effective management. You've reached the end of this video. Thank you for listening. If you like this content, please hit the like button and subscribe to our channel. If there are any specific topics you want us to talk about, please let us know in the comment section below.